Now, what would be some of the classifications in order for somebody to qualify for this? Because I think you have to qualify as a real estate professional. And can anybody in any business do it? Like if I'm a doctor, can I use accelerated depreciation? If I'm a restaurant owner, could I use this as well too?
Yeah, great question. This is one of my favorite things to talk about during our workshop is to break down real estate professional status. We call it reps. So the backdrop and the rules. Real estate is inherently considered passive in nature by the IRS. By default, it's passive income, and the losses that are generated from depreciation and operating this real estate are considered passive losses. Only passive losses can offset passive income, right? So those two things have to match up. Many people don't fall into that category because they have a ton of other things going on. They have either a regular W-2 job or substantial involvement in another business, tons of things, right? So they have a lot of active income. And then if they do real estate, they have a lot of passive losses. Those two things can't immediately offset each other unless you qualify, as you mentioned, as a real estate professional. So how do you meet that qualification? There are three things that you got to be aware of. Number one, you need to spend at least 750 hours in real property trade or business, materially participating in real property trade or business. What's real property trade or business? Real estate sales, broker, property management, development, all these different areas that we traditionally think of. So at least 750 hours in this space.
Question. Does that mean that if you're a real estate agent and you spend over 750 hours selling real estate that you automatically qualify?
No, you meet that first threshold of the 750 hours in real property trade or business, but then you also have to make sure you hit these other two that I'm going to talk about. That you got to have this whole thing. And I'll tell you also, real estate agents and brokers are notorious for violating this because of that assumption. So the second thing is more than half of your time needs to be spent in real property trade or business. That means more than 50%. So for those, as you mentioned, that are doctors or have a substantial business that they operate in different things like that, it's really hard to justify that you're spending more than 50% of your time doing real estate related things, right? Because you got a full-time job.
Yeah.
So you got to check the box on those two. And then the last thing is you need to materially participate in your rental related activity, not the rental related activity of someone else. So that's material participation in the actual properties that you own, right? And we'll have to kind of dig into material participation, but you got to have all three of those boxes checked. And that right there opens the door for you to use those passive losses from real estate to offset active income. Here's where realtors and brokers tend to go wrong. Is they make the assumption that because I'm selling property and that's what I do full time, I automatically meet the threshold. But they forget that last part, material participation in your own rental related activities, not the rental related activities of someone else. So as long as those things are true, then they can they're in a position to use those losses to offset their active income.
So let's go back to the doctor and the restaurant owner. What if your wife is a real estate agent and your wife basically spends more of, like, let's say one spouse is a doctor and the other one is a real estate agent, one of the spouses, would that meet that threshold? Would that be easier to justify one of the spouses spending the 750 hours in that, or more than half of your time in that department?
Yeah, so that opens the door. If the primary taxpayer doesn't meet the threshold, then yes, your spouse can meet that threshold as long as all those same things are true that we just walked through and you all file a joint tax return together. If you're filing separate tax returns, well, then everything is reported separately. But if they're joint, then it all flows through on 11040, and yes, you can use that. That's a great way that a lot of our doctor clients use that.
Yep. Now the last part is material participation. So like, let's say that like somebody like me, let's say I own 57 units. We self-manage all 57 units, approximately $12 million worth of real estate. Right now, we self-manage everything. But let's say that I wanted to I wanted to maybe diversify a little bit and invest with like a syndicator. And let's say there's a syndicator offering for the investors to keep all the depreciation, almost just for a tax haven.
Yes.
Let's say that I invest $1, they're going to give you $2 back in depreciation. Would that cause a problem? Like if I did that, since I have a sizable real estate portfolio, more than 750 hours of management, would that cause any problem, or would I be able to write that off? Basically, let's say I invested 300,000 in a year, and I got 600,000 in depreciation back from that investment. Is that something that would be allowable?
So that's a great question. And I tell you, tax professionals fight about this one all the time. There are a lot that are on the side of the aisle of no, you're considered a limited partner. You're not actually investing in real estate itself, so it doesn't meet that threshold. And there are some that suggest that you can aggregate, as long as you make the election to aggregate all of your rental activities together and treat them as one, then you should be okay. What I'm going to say, I'm not going to give a direct answer because I don't want anyone to make assumptions. What I'm truly going to say, and I think people beat up on us when we say this all the time, talk specifically to your advisor to see if that makes sense for you and if it's something that they think is defensible in the event of an audit. I have seen where you're a limited partner inside of a syndication and you meet the qualifications for being a real estate professional and you elect to aggregate all your activity as one, where some people will then take those losses, whether they're losses from that syndication deal that, like you just mentioned, or your actual real estate that you own, and treat that all as one. But I've seen other people who says, nope, that's not right. You're going to get audited and you're going to lose. So talk to the tax professional, see if that makes sense for you. And yeah.
For your clients, what is your response?
Well, it depends on their unique situation and what we think is defensible. If the facts and circumstances suggest that that aggregation works and we have the code section to back it up, then we're going to go for it. As long as we believe we can reasonably defend it in an audit and win. And of course, the client has to be on board with this as well. So that's the one thing that's important. They ultimately sign the tax return saying, I agree with everything that's on here. So as long as those two things marry up, then we'd go for it.
It's funny because when I first reached out to my accountant about it, he said no, and then he did some more research, and then he said yes. And I think that's what you were referring to in regards to, is it a coin toss? But these are like more advanced tax strategies. Now, let's say that somebody didn't have a sizable real estate portfolio and just wanted to invest with a syndicator, and they were a limited partner versus a general partner. In that case, is it less likely that it would be defensible?
Yeah, it's going to be less likely in that regard because you have the burden of material participation. When you're a limited partner, it's really hard to meet material participation. Now, there are some unique ways to do so. They're not easy or can be done without proper guidance, but it can be done. But that's going to be the big drawback there is if all you're doing is investing in syndications as a limited partner, you can't really meet the material participation part, then none of it falls into place.
And then what happens if I forgot what I was going to go. Okay. So let's go into, and I love this topic and I'm so grateful. I don't know if anybody has ever told you this, but you have a really good way of explaining things in a very simple way. And it's almost like I could tell this is not your first time explaining some of these things because you have like perfect examples for everything to make it very simple. So I appreciate that, and obviously interviewing you.